Greetings, Jonathan. Camarda, Chief Investment Officer, as we end the final full week in August with a rather resounding thud after the Jackson Hole debacle, let's call it. Again, I'm going to keep pretty much the editorial out of it, except for the fact that Fed Chairman Jerome Powell, obviously has reverted back to his 2018 playbook. Certainly, there's been some more hawkish Fed members that have been in his ear, as he pretty much laid out today that regardless if recession becomes apparent, slowing down statistics like inventories, even some of the employment data, which is subjective, and certainly housing, supply demand, regardless if they show slowdowns like the GDP has, that they are going to continue to put the hammer down until they get to 2% inflation. And what that means is, and of course there's no route to that, they didn't lay down a time frame because they don't know. And they don't know what the other factors look like to get there, who's bludgeoned, pretty much as what he had stated. And so you saw the markets drop precipitously. Now, that aside, as again trying to unfurl the Rubik's Cube of what's going on inside of his mind, what I'd rather do is talk strategy here in a very succinct video. So really, you saw us taking money off the table in all the strategies really over the last few weeks. A couple of the strategies you saw some rather short positions put in, like in macro momentum, which paid off today. However, this was pretty much a binary event. In other words, if he came across like he did over the last session or two, when we talked recession right here in mid-June, the way he was throwing his pitches, proverbially speaking, then you could have had a rush to the upside. In fact, in the hedge fund community, there certainly were bets on both sides. In fact, there were many leaning towards the dovish side. That didn't happen. But we came in as prepared as I guess we could have, given the binary outcome, in that we had a good amount of cash, treasury obligations, money markets that pay a decent yield. Some of you have some hedged strategies. Some had some short strategies, like I said, in macro momentum, and certainly really no sector was really spared today. So beyond today, where do we look? Well, if we look technically, the market, again, as we discussed last week, has been pretty much resisted to the downside off of some major longer-term moving averages that we're keeping an eye on. And so that's what we have to be cognizant of, is with not only a non-accommodative Fed, but a pretty stubborn and single-minded Fed, that we do have to keep our head on a swivel with the proverbial grizzly bear at this point. No sleeping in the tent, so to speak. In other words, we cannot become complacent. So therefore, you'll see in your strategies, we've been taking gains off the tables really the last few weeks in preparation for this. Of course, you don't take everything off the table, right? Because if it rips to the upside, clients, you guys want to make money as well. So it is a shade of gray. As you look through the strategies, we peer into each one of them. Again, macro momentum has some shorts in play, certainly some longs as well. And again, over the next coming weeks, we will have to make adjustments to that as well. And then sector rotation, you'll notice that, which held up pretty well today as well, with a good bourse in cash and money market, and sectors like energy and such, which everything got hit. However, better allocated than it was a few weeks ago for something like this. And then strategies also like active capital preservation, down today, but not nearly as much as the market, as everything got hit. But again, we continue to still have a pretty strong dollar bias in that strategy, and for good reason if you heard the Fed today, especially if you look at the carnage that is the Eurozone, right? And then in strategies like opportunistic growth and income, that is more of a buy and hold strategy that's fundamentally based, that looks at tax harvesting opportunities and only in severe technical situations may it make moves, continues to chug along fully invested at this juncture. Now, depending on your risk tolerance and your risk appetite with your personal wealth advisor, you can discuss the percentages that you have in each strategy and if that really resonates for what you're trying to accomplish, which of course is the most important thing. That's what our job is when we just strip away what the models are doing themselves. In global macro and velocity raptor, those strategies have been pretty proactive as well, as taking gains off the table and in some cases taking some short positions as well over the last few weeks. With that being said, we will continue to be eternally vigilant as again we move into what is generally a perilous time of year in confluence with a Fed who certainly seems to be single-minded in what they want to accomplish. With that being said, so we may see continued more furniture moving and more cash and more conservative investments accumulated. Again, nothing's binary, so we'll be eternally vigilant. We appreciate your time, your patience, most importantly, your trust. Signing off, Jonathan Camarda, and until next time, stay frosty and try to enjoy your weekend.